I don't care how good you are in anything. You don't have discipline. You ain't nobody.
Right.
You're nothing without discipline. Because you give up on the slightest struggle without discipline. Discipline is doing what you hate to do, but do it like you love it.
Hey everybody, we are with Kevin Green today. So Kevin's a guy that I was actually talking to recently on Spaces, and I was like, man, this dude really knows his shit. We talk, and he's intelligent when he talks about commodities, equities, bonds, crypto, even, and getting into like things like technical analysis to fundamental analysis to everything. Like he can just talk it all. And I was like, I really got to have this guy on my show. I'm really interested to talk to him a bit more. So Kevin works for, you take me off there and go for who you work for today, Kevin. And
Yeah, I
you were
work for the
also part of
Schwab
the
Network.
derivatives team. Yeah.
Yep, I work for the Schwab Network. I'm a senior markets correspondent, a senior correspondent there. And actually, before taking over this particular role, which I've been in for about a year and a half now, I was running a derivatives team for about 7.5 years. So I've been in the industry as far as trading goes for, I would say, over about 11, 12 years at this point in time, and then finance as a whole for a little bit longer than that. So been always around the financial markets, started taking a little bit of a liking when it came to options and in the commodities markets, and that's kind of where I focus on, but also dabbling into the equity market as well, because obviously that drives a lot of market commentary these days.
No, that's perfect. And I just want to go through a little bit. So as a derivatives team, what do you do specifically? Because some people hear the word derivatives and they don't know what that means. So what are derivatives technically?
Yeah, definitely. So when I was running the derivatives team, we helped out clients, retail traders, with learning options trading, futures trading, and even just some of the complex strategies when it comes to trying to manage their portfolio. So when you're talking about options, that's usually what people talk about when it comes to derivatives is the options market, and that's the biggest market from a derivative standpoint for retail traders. So working on calls, puts, putting on butterflies, iron condors to just simple strategies. So that's really the gist of it. We were not providing any type of advice or anything of that nature, just kind of more educating and assisting with placing trades for customers.
No, I love that because I think that, and something we talked about a little bit earlier, which is a lot of traders kind of get into that market initially, like it's the first thing they ever trade. And I always tell people like that's just the complete wrong thing to do. If you're getting into trading, like you do not want to just jump into options trading. It sounds cool. It sounds fun. And also it's really cool when you make money doing it because you're like, wow, overnight I made whatever. But really like you can blow up the same way if you can make 1,000%, you can certainly lose 100%. So I think it's really like once again, it's like it's an incredibly strong product, right? Because you can make a lot of money using them correctly, but most people don't. Most people take 100% of their account. So it's good that you guys had a service that actually tells people like how to use them correctly. Because I don't see many people who do, you know.
Yeah,
So
there's a lot of volatility when it comes to the options market, and you're right, especially if you have uncovered strategies, which could be very detrimental to a particular portfolio. And that leverage, oh, as you said, is a benefit for some, but you're racing against time. So it's not only trying to get the trade right as far as a price point for a particular stock, but also trying to get the timing right as well is also a very key element, which is where you kind of see that theta decay or where you see that risk reward ratio starting to go against the trader's favor if they're not utilizing the products correctly.
no, totally. That makes so much sense, and I hope that everybody like got a lot out of that disclaimer because there's good way that like there's great ways to use it. We have a trade on right now, a very simple trade, but it's 1% of our portfolio. So at the end of the day, if we only lose 1% of the portfolio, you can make 10% of the portfolio. That's how you really structure those. You don't look for like, hey, I have 100% of my portfolio in this, and I'm hoping for 1,000x gain. That's going to be incredibly dangerous. So it's great that you said that. So jumping into it next, so your strategy, you look at global macro from a fundamental angle, a technical angle. Like you'll have conversation with me, and you'll be talking about price levels, and I'll be like, man, I didn't think this dude actually knew that stuff because you're literally looking at price levels for like CTA signals and so on. How did you kind of come to this strategy that just kind of encompasses a little bit of everything?
Yeah, I would say to start off, when I kind of analyze the marketplace, just in general, I probably leverage around 60% of it on the technical analysis side. Then I would say 30% of it is going to be on the fundamental analysis. And then kind of that 10% sliver is utilizing flows or looking and monitoring trade flows. Now, because that does have a very big impact when it comes to the marketplace. So once those kind of align, that's really where you kind of identify an area where you could say, okay, well, this, stock or this ETF or this, commodity can move to the upside or can move to the downside. Maybe it's going to stay here. And that's kind of how I've been able to see it over the years. And obviously that takes a lot of time and effort, but I have a data analytics background. So at the end of the day, I kind of do this as a hobby when it comes to programming and things of that nature, looking at the minutia of the data that's out there for companies and really focusing on it for the commodity space as well, which we'll probably go into a little bit. And then, when you find something that aligns where the fundamental case can be made, the technical case can be made, the flows themselves can be made. That's kind of where you can say, okay, well, there's a potential for a move in this particular product. And that's kind of how I've been able to leverage it. And, it's not for everybody. People have been very successful utilizing just technical analysis, and that's it. People have been really good when it comes to fundamental analysis. And I think it's really key for traders out there to have the conviction into a particular setup. And if you don't have that conviction, that's when you can, second guess yourself. You can get out too early, you can get out too late. And that's something that I've learned over time, obviously, because we all have winners and we also have losers as well. And I've been on both sides of those trades. So that's kind of how I strategize it moving forward here.
No, that's great. That honestly sounds like something I would say because that's everything to me, which is like finding out what works for you, right? And then like also understanding for me, even like I'm the same type of person where it's like I'm looking at even things like seasonality, flows, sentiment gauges, whatever, and you look at all of it and then you piece it together. But I also know like I don't get paid unless the price moves. So then that's where my signals come in. So I can have an idea. Oil was kind of an idea. You had it too, same as me. We could see a spike here. It makes perfect sense. There's enough going on geopolitically, but wait for the signals to come in as they come to really see a trend change. So, we're kind of seeing that right now. And that was something you and I talked about a bunch. And, that's the first thing, the first slide you actually have up. And I'll jump into that as soon as I figure out how to share this screen properly. There we go. Okay, so now that we're looking at this screen, so we're looking at crude oil. You sent me this thing of crude oil net speculative positioning. Can you explain what are the net speculators?
Yeah, definitely. So this particular chart looks at non-commercial traders within the crude oil contracts here. So it really takes those that are managing money as well as those that are non-reportable, which we consider those to be those that they have a large dollar amount that they have to be able to report that they have a position, but they're not an institution or they're not like a producer. So there's different classes of traders when you're looking at the commodity market. Just in general, you have your producers. Those are actually the ones that are, extracting oil, refining oil, things of that nature. Then we have the swap market traders that are out there. And really what they're there to do is be able to offset risk. So they might take a trade in from a physical producer that says, hey, I need to hedge I need to hedge oil at $75 for potential downside risk. They'll go out into then the futures market to basically facilitate that particular trade. And then they make a very small amount of money on the spread. They're not really that influential. I don't really follow those flows. And then you have the net speculators. So what this chart is really showing us here in this setup is that net speculative positioning is at I would say a pretty decent level to the downside here. There's not a lot of long traders that are in this market, a lot of short sellers, especially when you're looking at the managed money funds here. And if we go back, you can kind of see the same type of situation occurring several times. Last year, which is that first dip to the right there, last year we had the same setup going into July. Remember when we saw that nice spike from July to basically September where we hit around $95 shares and then sold off. Same type of setup, same type of scenario that I kind of highlighted here. So right now, what we are seeing is not a lot of individuals want to go long this product. Producers have been increasing their short positions, and that's rightfully so. As inventory continues to build, as their production continues to build, they need to hedge that type of risk. They need to hedge price risk. And I also kind of look at that too. So when producers start to increase their short positions, that also creates a floor, because a market maker has to go out and take the other side of that trade. And if they are taking the other side of that trade, it could be a setup where these producers are setting up to be able to offload some of their inventory into the marketplace, and that could give you that foundation for price support. So once again, kind of going back to that formula, this is a fundamental setup, one of them, one of many fundamental setup to say, okay, there's not a lot of longs here. There could be an opportunity where people get squeezed because they are short-sighted when it comes to the crude oil market. So this is what that chart's really trying to highlight here.
Oh, sorry, my mute went off for a sec. But yeah, so when we're looking at that, and I think this is great because honestly, this is something I get so many questions about, is how to read the COT reports. And so many people ask about it, and they ask for videos for it. And I've made a couple videos and I've made a couple letters about it, but this is something where we can really dive into it and kind of figure out how it works in trading today. So I'm seeing the same thing as you are. I'm seeing that speculators are very bearish for no reason. Like, really, there's a lot more reason for upside risk than downside risk. And I'm also seeing that the commercials, the producers are still buying. So we put, once again, like you said, puts a floor on the market. We've seen this floor happen in oil. If we're heading into recession, most of the time we see oil just break down again and again and again. And now we're kind of seeing this floor in this market. So when you're looking at this, how does this pertain to today and what people should be looking for in the oil market?
Yeah, so we're pretty much at a crossroads, and that's how I've really been looking at the oil market in general. So it's kind of a 50-50 type of scenario. Yes, we have some fundamental factors when it comes to inventory builds that have put downside pressure when it comes to crude oil prices. But you also have a situation here right now where we're testing a really key area from a technical standpoint, that 200-week moving average, and I have that on another slide here. But basically, we don't usually break the 200-week moving average unless we have some form of an economic downturn, even outside of supply hitting the marketplace. There's one instance where we did have supply hit the marketplace, and we weren't in an economic downturn at that point, and that was when the Saudis actually came out and really just flooded the market back in 2014, 2015, and tried to pretty much kill off the shale boom, if you will. And they were actually very successful. They brought oil down to like $40, $35, made it very unprofitable for a lot of producers here in the Permian Basin and Bakken to be able to be profitable. So operations started to slow down. You started seeing people getting out of Oklahoma as well, because that was a really huge area when it comes to production. So once again, I'm looking at the technical setup. I'm looking at the net speculators and saying, okay, looking at this chart, even if you're a technician and you're looking at this chart here and you understand the fact that there's a lot of short positioning there, what could happen if prices move back to the downside and break that 200-week moving average and we continue to go? It's most likely a sign that the overall broader market is also seeing a slowdown, and then that would also be felt in equities. If not, and the economic data suggests that we are not in this a significant economic downturn. There's certain data points that does say, yeah, we are seeing some slowing. But overall here in the United States, and for the most part globally, outside of, let's say, the EU, we're in a decent position. Either we are coming out of an economic downturn like in China, or we are sustaining some upward momentum when it comes to consumer spending. So if these trends continue and we don't have this drop off in the economy, then you could suspect that demand for crude will continue to rise to the upside here. And that's kind of like one of the bases here. There's other factors, and we'll probably get into those here in a second. But once again, this is kind of a key cornerstone when I'm looking at the oil markets. When net speculators get really, really bullish, like we see in the middle of that chart, and we get a little bit overextended, that's where the spidey senses get go off as well and say, hey, maybe we are bound to see some sellers coming in. What I love about the crude oil markets, or any commodities for that matter, they don't just go straight up and remain like equities. At some point in time, there is a balancing act of supply and demand that either brings prices to the upside or brings them back down to the downside. You usually don't see elevated price levels for too long outside of an inflation adjusted basis, right? So you can look at gold. Gold has moved up over time, yes, but if you're looking at it from an inflation adjusted basis compared to the equity markets, you can kind of see that relative strength and be able to, pick and choose to see how, price is going to react in the near term.
No, that's perfect. And I, like I said, it's just great that you're on here doing this right now, because it's something tool I always use. I'm always looking at the COT reports, and that's to me the biggest fundamental data that I do use and see over and over again. Yes, I can look at manufacturing and GDP and all of these things. However, the thing that's actually going to help me to figure out where I need to be positioned, what I should be looking for to put trades on, that's really going to be the COT reports. So next chart, can you explain this next chart that you brought?
Yeah, so this is the OECD inventory reports here. So this is like the Organization for Economic Cooperation and Development. Think about this as the very watered down version of OPEC, but for the Western world. And this is just the inventories that we have. So it's got the UK, it's got the United States, a whole bunch of other different countries that are part of this here. Now, this is that bear case that we were talking about, that pressure front to the downside is because we have seen an increase when it comes to inventories. But what's really interesting about this chart over the last couple of months is that we are starting to see it hinge back to the downside. So I do believe that we will probably see a little bit of a leveling off here when it comes to production. And maybe that's going to create a draw on inventories. Just keep in mind here, when we're talking about a commodity, there's businesses that are also utilizing this commodity in one way, shape, or form. And it doesn't really benefit an energy producer or an energy company to continue to ramp up inventories if your margins or the spreads are starting to get smaller and smaller. That eating into your margins does not help your shareholders. So we are kind of seeing this imbalance right now where inventories continue to rise. Yes, we're seeing demand destruction in certain respects, but I would suspect that once we get to the driving season in April and May, we will probably start seeing production starting to level off, and then this huge buildup in gasoline inventories. Now, this is oil, but gasoline inventories also have been rising at a pretty rapid clip. I believe that the inventories for gasoline will start to get drawn down as well, because the spread between what we are looking at right now for gasoline versus the April contract is around 20 cents. That's actually fairly healthy. So I think a lot of these energy producers are trying to get ahead of that curve, utilizing the inventory that's in the market right now, refining it, storing it, because storage costs, when you're looking at it onshore, is very cheap. And then once again, capturing that spread when the time comes in April and May, in the event that consumers start to ramp up consumption again in the summer seasons, going back to that seasonality effect that you've been mentioning even earlier.
Yeah, and jumping into the next one, because that's perfect and segues right into this one. And you were talking about this a little bit earlier. That's a beautiful chart. The 200-week moving average, and I'm not a believer that the moving averages are magic. There's some people who think that when you first start trading, but over time, it's no, moving averages aren't magic, but they can kind of tell you where these valued levels are. And right now we're really sitting on, to me, the 200-week moving average is the most valuable indicator that you can kind of look at in a very long-term scale, kind of figure out where you might want to be a little bit more bullish, where something is pulled back to. And most importantly for me, if it holds that level, I'm really interested.
Yeah, definitely. So I'll speak to technical analysis here real quick before we kind of highlight that chart. So technical analysis, whatever type of moving average you use, or whatever oscillator, or if you're using the ADX or what have you, I find the value in technical analysis in being the fact that somebody else also believes in those indicators. So that's why I always keep them in mind. The 200-week moving average, there is a strong correlation here when you're looking at this chart. But if the market cares about the 200-week moving average, then I'm going to be mindful of that 200-week moving average as well. Just like if you're using a 9-day moving average in futures, or a 20-day moving average when you're looking at equities, or a 50-day, what have you, they may have value. There's books that people have written all about the intricacies of these particular indexes. For me, it doesn't really matter too much how much do people and traders really care about them? And that's what I'm going to value as well. That 200-week moving average, we don't break under that too often, to say the least. And when we do, we also see it also coincides with economic downturns. So once again, seeing that huge disparity around 2013, 2014, where there's a huge gap between the 200-week moving average and the price of oil. That's when we saw Saudis basically really flooding the market. And then shortly after that, about 6 months to 8 months after that, the broader equity market sold off and we had a little bit of an economic downturn. But we usually touch it, bounce right up, and then move back to the upside here. We have another one where it crossed and moved to the downside right around 2020. 2019, 2020, what is that? That's COVID-19, right? An economic downturn, also having that being reflected in the equity market, seeing that in crude oil. Now we are testing those same levels. We are at a crossroads, and I think this is more than just inventory builds. This is definitely more than that. I think this is going to be driven by demand. If we do see a break to the downside, I think there's going to be wider implications when it comes to the broader equity market in itself. But once again, this 200-week moving average typically, for the most part, actually holds for near-term bounces. So kind of like you and I have been talking about here, we violate or we touch it and we bounce right back up. Who knows where crude oil can go? And I don't think, I'm not the type that says, oh, it can go to $100 or $120 or $150 or things of that nature. I kind of look at realistic ranges where you could see prices hit $85, maybe it touches 90 before it backs off. And I never really give a time frame either, because you know that price action can change very rapidly. But this is another technical setup on top of the net speculative positions. They're short already at pretty historical levels. The 200-week moving average, very strong moving average that oil prices typically bounce off of outside of any type of economic event. And so once again, that short-term bounce to the upside is that bull case.
No, I love that. And also one thing to just add, which is something that's incredibly important. So there's if you backtest and you backtest a upward sloping 200-week or 200-day moving average compared to a downward, it's completely different. So it's kind of interesting to see that we're kind of hitting off this very strong upward sloping moving average. We didn't break below it. Like, there's a lot of things to be bullish about technically in oil. We just made a 100-day high. All of these things continue to kind of give signals that fundamentally, technically, oil is going somewhere, even though like the picture for people looking at just the fundamentals are going, oil can't go anywhere. Mm-hmm. And I know the market's forward looking. There's no way to tell for someone to tell that, hey, all these inventory levels are going to stay exactly the same. Everything, all the projections are going to stay exactly the same. Like, that's crazy to actually think that. And like you brought up the other week, you pointed to an indicator. I can't remember which indicator you were using at the time. It was manufacturing, and you were talking about it bottoming. Do you remember what I'm talking about?
Yeah, we were looking at the LEI, actually the leading indicators that's provided by the conference board. And so we are seeing a little bit of an uptick. Now, the latest report still showed a month-over-month decline of negative 0.1%, but we're starting to see that slow. And that's also potentially an indicator that manufacturing is also potentially bottoming as well. And kind of going back to that case, you manufacture more, you need commodities in raw goods in order to do that. Basically, here's a case. When I look at the commodity space, I'm gonna go on a little bit of a rant here real quick.
Please.
Companies are not going to outperform revenue without greater sales, okay? Especially when they're industrial and manufacturing companies. In order for them to sell more, they need more inventory. They need more raw goods. They're going to purchase those raw goods and position themselves to be able to create products, whatever widget, to then be able to sell. We usually will see an indication within the commodity markets first before we see anything in the equity market. And there's no industrial company that comes out and screams at the top of their lungs to the broader market, hey guys, we're buying more steel. Hey guys, we're buying more oil. You just see it in the price action alone. And that's kind of another area that I'm focusing on here. So we have the LEI, we're starting to see it give a little bit of a potentially a bottom that's going to be ultimately bullish for the most part when you're looking at the manufacturing sector. Now let's see it actually take place when you're looking at copper, when you're looking at oil, when you're looking at gasoline. or soybeans for that matter, whatever. Once you start seeing that price action move up, once you start seeing those commercial traders starting to buy up more of those products, or if they're a producer, maybe selling more because they have a little bit more inventory, now is the time to actually get in. That's when you're going to see it show up in companies' financial reports. You'll start hearing it on a conference call. But if you're waiting for John Deere to tell you that their steel inventories have gone up and they're starting to see a huge spike when it comes to customer demand, guess what? They've been trying to acquire those materials 2 months, 3 months in advance in order to do so. That's why the commodity markets are just a phenomenal indicator as a whole, because you're going to see the actual activity that it takes to create profitability within these raw goods first.
No, that's perfect. And it's a good rant, because it's something that's incredibly important when you're looking at trading, and the people who trade the price action, like there's a reason why trend following and systems and 100-day highs and 200-day highs works. It's just because there's always some information somewhere. And I think it's interesting that you brought up the index, because for me, I'm always looking at stuff like that, because when they're at such crazy low levels, and then you see something like oil start to tick up, start bottoming, it even had a little bit of a run recently, like when you see things like that happening, even though there's new lows in the manufacturing index, and like you said, like they're not going to come out and just tell you that. So how do you read that? You look at the COT reports, you start to study the price action, so perfect rant. I love it, because that's something that's just so important in trading and so many people don't talk about. Oh, great. Soybeans. Perfect. So let's jump into soybeans. And for me, that's one thing that we get on these rants when we're on spaces. And I feel like people are just tuning out because they're sitting there and going like, man, why isn't they talking about Tesla? And the other day there was the spaces on Tesla, and I just sat there. I didn't say anything the whole time, because I was like, I don't really have an opinion one way or the other, but we're talking about something like soybeans, like now we're talking, and a lot of people watch this podcast to see a lot of stuff about the commodity space. And I think it's something that's incredibly powerful. Like if you want big returns and you want to trade in a big way without having to take off crazy risk, like just buying naked options or something, or start selling naked options, like this is the way to do it. So getting into soybeans. And so what are you seeing in the soybean space?
Yeah, so this is kind of a similar chart. So we're looking at net speculative positions, and it looks like some of those arrows are a little bit off kilter there, but it's okay, because we're going to get the same type of concept here. What we are seeing right now is net speculative positioning from the long side is very, very low. A lot of shorts are within the soybean marketplace right now. Now, I have to have a little bit of a caveat. There's a reason why. The inventory levels, when you're looking at the soybeans across the globe, especially here in the United States, they're actually higher than what they projected to be for ending year stocks of last year, which also then turn into beginning year stocks of this year. But we have seen actually some green shoots when it comes to the activity. We are seeing China buying a healthy amount of soybeans over the last couple of weeks. Also, we've seen that in the wheat market as well. And they're starting to ramp up. And we have seen this, the rumors out there regarding China and their stimulus measures. Those might take some time, but along with those stimulus measures, they will also need to obtain more soybeans. So this is another situation where this does appear that it might be a little bit oversold. From a seasonal standpoint, we're in January right now, so prices for soybeans are going to be low historically, but they should start ramping up in February and March as we get ready for the planting season, and as a lot of these countries are starting to utilize their stockpiles that they had from the early growth from last year. One thing to also kind of note here, we have several different dynamics that could actually move soybeans to the upside. And there's other certain dynamics that could push it to the downside. So this is not so much of this isn't the exact type of setup that we saw for crude oil, where we can continue to see bullish shoots in the marketplace outside of inventory. This scenario here also kind of depends on the weather. It also depends on production coming from Brazil. Brazil is a very big producer when it comes to soybean. Also, another big producer is Argentina. So if they have really great harvest this year, they could also flood the marketplace. So that could also depress prices. But we're going into we're in El Nino right now. Historically, that has created very volatile weather patterns, weather systems, and we are actually seeing the effects of that right now. In Brazil, we are seeing a situation where their yields right now, which they are harvesting, are not that great at the end of the day. So that provides you a little bit of upward pressure when it comes to prices. In Argentina, for the most part, it's in a dry spell. Now, the next 2 weeks are going to be critical. If they don't get the weather that they need, their crops are not going to do that great as well. That would increase the demand for U.S. produced or U.S. grown soybeans. That's another bullish case. But once again, we're seeing this outlier. And the outlier right now tells me if there's more risk reward to the upside than there is downside risk, given how early we are in the season and giving this soft landing, no landing type of scenario, what have you, where consumers are going to continue to spend. And if China is going to have a recovery, that's also going to require greater consumption. Greater consumption means that commodities, once again, are going to see demand. Everybody needs water, everybody needs food, and everybody needs shelter, right? That's why I love commodities, especially when you're talking about soybeans. Soybeans are the most, one of the biggest, protein-rich sources that are out there, not only for food consumption for humans, but also when you're looking at livestock. And an economic expansion or recovery for China should also coincide with greater consumption for grains as a whole.
No, it's perfect because it's something I keep writing about. I keep writing about soybeans and the soybean complex and what's going on with soybeans. And what you said is so dynamic because if you're looking at Brazil, Brazil even has, if you look at southern Brazil, it looks one way. If you look at northern Brazil, it's another way. Like it's wild right now. But if anything's a bit off, like soybeans could explode to the upside. The problem that I've been having with this is that I keep pointing to these facts and I keep seeing that, hey, soybeans look great, corn even does. Like there's a lot of good dynamics for commodities, agricultural across the board. But I'm still waiting for the price signals. The price hasn't shown up yet, and that's the thing that really has to show up for me. And I'm sure for you too, is like that's why I'm mixed on how I feel about it right now. I could make a bearish case, I could make a bullish case. I'm leading more bullish than bearish, but if we finally did see that price action start to show up as well, I think there's a major trade in that space setting up. In either way, there's a major trade setting up in that space. I think it's good that you bring up the planting season and the commodities, the way they're so cyclical. And like if we are going to see a setup and that setup is going to be an awesome setup, it's going to be happening soon. So either way, like you need to put that chart on your board and be ready for it in one way or the other.
Yeah, and I would say also the volatility, we usually see a lot more volatility when you get to April and May, right? So that planting season and the main planting season here in the United States. And so we have right now the winter season has actually been very mild, but if we have this situation where we have an extended winter and it delays the planting season as a whole, not even just talking about soybeans, but as a whole, when you're looking at corn, that can also push prices to the upside. If you're looking at a price chart, if you look at a 5-year weekly price chart for soybeans, we are at a crossroads. Once again, hitting around that 200-week moving average, but there is a shelf. And we could see a dramatic move to the downside if the stars just do not align for that bull case. And we do see this flooding in the marketplace when it comes to soybeans here this year. And consumption does not increase because of economic slowdowns, or maybe the stimulus packages do not work in China. There's a huge shelf to the downside. But once again, I kind of go risk reward. The inventories that we started with were higher than what were expected. But if you're looking at it at a historical basis, it's actually relatively low. So the utilization rates are still at pretty key levels to make a bull case. And I think it's more bullish than bearish. And then you have the geopolitical factors as well. So if we have any issues in the Black Sea when it comes to Russia and the Ukraine conflict, that could be an issue. If we see anything in the Red Sea, there was a ship that was targeting farming equipment and grains about a week ago, right? Something like that could also push it back to the upside here. So there's definitely a bull case to be made, but there is a price shelf that could drop dramatically if we don't see that materialize. And that would be something that probably would come in September and October once we start seeing the harvest being realized here in the United States.
No, that's perfect. And getting I didn't even mean to click on the next one. How do I go back? Just hit that. But yeah, no, like there's so much going on in that whole complex right now. And so I completely agree. Speaking of next, what are you seeing in the wheat market? I'm really curious about this one because I'm kind of at this. We had a full buy signal, fundamental, technical, everything, and then that basically went up and got stopped out in I think a couple weeks. So what are you thinking in the wheat market right now? And how does that pertain to your soybean thesis, if at all, if it does at all?
Yeah, so I'm keeping the soybean thesis kind of away from the wheat thesis. A major part of the soybean thesis is that China is going to continue to increase their buys. When China buys a lot of the soybeans, they're doing their own crush operations overseas. Basically, they're heating up these soybeans, they're crushing it, they're making oil, they're making feedstock, they're making, byproducts for tofu, whatever the case is. So there's a bull case to be made because of that China story. Wheat, on the other hand, is still kind of a China story, but that's also going to be a little bit of a Middle Eastern story as well when it comes to demand. But here's where we see a disconnect. So once again, this is the net speculative positioning. We did see some bearish activity. We did bounce off of that. We moved back to the downside. I don't have a wheat price chart, but if we look at the highs by about going on 2 years now from the Russia-Ukraine conflict, just when it first started, we saw this huge spike to the upside in prices. Ever since then, there is a downtrending line that has just been on point for the last, say, 2 years. And we actually just hit it like 2 weeks ago. This is probably what you're talking about, right? We hit it like a week ago or 2 weeks ago, and then it failed. So that strong trend line has to be broken. And unfortunately, it's been in place for 2 years. So the technical setup still says downside risk, but we have this huge like triangle, descending triangle pattern that's forming, that's coming to its apex. So either it's got to break up or it's got to break to the downside here. I think when we look at net speculative positioning over the next couple of weeks, we will continue to see bears coming into the marketplace, probably hit that bottom. And then we have that point of control, and we have that point of conflict, if you will, where we're going to either break to the upside or downside. I think the geopolitical risk is definitely there. I don't see the Ukraine-Russia conflict ending anytime soon. It's not my only case, but any type of Black Sea disruptions are definitely going to push wheat prices higher. And then we also have, once again, that weather situation. So if we have an elongated winter, we won't be able to get potentially 3 crops in. So we can grow wheat for the most part year round. If we're unable to get that first main primary crop in because of the elongated winter months, if you will, I think that's going to be ultimately bullish. So kind of a different dynamic than soybeans in a sense. Demand for wheat is still very high when you're looking at the Middle Eastern markets, and their economies are for the most part fairly strong. But that technical setup still kind of points bearish. And I'm kind of looking at that apex as either, you're breaking up, we're going to see a rally, or we're going to break down and we see move to the downside. But inventory levels better than what the street's expectations were, but once again, not outsized. So it's not like we have a huge glut of wheat sitting in stockpiles right now.
No, I don't. I think the same thing, and we're kind of looking at. I think people continue to look at it as in, the commodities in general. Like, hey, they're dead. Hey, they're dead, and it's like this is a normal part of the cycle. Like in a commodity cycle, like I think the thing that people don't understand is, the basic rules of a bull market and a bear market: up 20% from the bottom, down 20% from the top. In equities, maybe you could use that. I wouldn't use that, but in equities, sure, you can use that. In commodities, sometimes it's like 50, 60, 80, in the middle. I can't tell you, if you go back and you research the 70s, look at sugar. There was a point where I think sugar fell 80% in the middle of a bull run. I mean, that's insane. Some of these, they do that, and they can fall and they can be dead for a long time. It's just the way the commodities market works. That's why I always say people, if you're a trader, the volatility is great. You can get in, you can get out, you can make trades, you can put together a fundamental, technical thesis, however you want to do it, and you will have these trades that will come up. But in equities, people like to compare the same. And it's the same thing too. It's like we always talk about this online, which is if we're talking and we go, hey, I like this trade, it's always like, hey, but understand this, understand the size. Like commodities are, if you're sizing futures positions, you have to size them based on volatility. If the volatility of a product goes up to some crazy level like Bitcoin, basically you put Bitcoin here, put commodities here, put equities here, even a little bit lower, and then put currencies, bonds, down here. And now you kind of have a framework of understanding what type of position you should have. The smaller, like the currencies, bonds, that's going to have the biggest position. Bitcoin, natural gas, like absolutely natural gas, like that's going to be the other way. You're going to have the smallest position. So understanding those things in the context of the commodity space is incredibly important too. But that's just a disclaimer you and I kind of talk about all the time.
Yeah, and I always think about it
too.
Right. And I always think about it too. When we talk about managed money, we're talking about the ETFs and things that once they get on one side of the trade, I'm not saying all the time this is going to work, right? And I'm not providing any advice. Once everybody gets on the other side of the trade, or one side of the trade, especially retail and ETF fund managers, that's when you want to say, okay, watch yourself. Because usually that's an indication of a peak. And we saw that last year when it came to September, and we hit like $95 on crude. And everybody and their mother wanted to be in energy stocks. They wanted to be in energy, the USO. They wanted to do all this stuff. And it's kind of like, okay, but producers aren't matching your flow. And if producers aren't matching your flow and market makers don't have to match your flow, then it's about to be a race to the bottom at the end of the day, right? You're trading amongst each other. And so when commodities fall out of favor of the mainstream, that's kind of when I keep my eye on it and say, hey, there could be something here. Because they just don't go straight up and remain straight up for the most part. If you back out seasonality. And so I think that's the key area. And Penny, like you talked about too, having that right size and risk parameters is going to be key.
Nice. No, perfect. So moving on to the next one. So this is just, I think it was Visual Capitalist made this chart a long time ago. And they keep updating it and I keep watching it and I'm like, it's very interesting to kind of see these bottoms in equities compared to stocks. Now, once again, it's like you said, like commodities are very cyclical. There will probably not in the long term. I'm not saying buy oil and hold it for 30 years. You're going to be rich. I will never say that. I will say like it's a good trading vehicle. These are all good trading vehicles, but we are at the right time in the cycle to usually see this kind of crazy move in the commodity space. And I wanted to ask you too, is like, do you look at this type of chart and see anything on it that makes sense to you where we're at right now?
Yeah, I think there's definitely I think the stars have to align right to see these super cycles, because that's really what you're highlighting, right? You're highlighting the super cycle type of structure when it comes to commodities. So not only do you need to see demand be fairly healthy, but you have to have some type of supply constraint that's in place that can last for a very, very long time. And usually that's going to be geopolitical events, and that's an unfortunate situation, right? So when we invaded Iraq and Afghanistan first, but then going into Iraq was really that big push where oil sustained itself over $100 for a very long time, a long time when we're talking about commodities, right? On a relative sense. And so that's kind of that event that can push it up. If you have any other type of constraints, you're bringing up, sugar. If you have a horrible sugar crop season and a lot of your sugar cane gets hurt, gets damaged because of some weather event, I mean, it takes some time to regrow that cane, right? It could take a year or 2 years, even 3 years in certain respects to have your yield come back. That's a supply constraint type of an event. So I would say all of those probably do align in one way, shape, or form with these cycles that you're seeing. I think the market's definitely discounting the geopolitical risk that is out there right now. That could be that risk factor that could push it higher. Are we there yet? I don't think we're there yet. But if you're looking at it from a seasonal standpoint, it's kind of like looking at IV, right? IV's been low for so long. At some point in time, the cycle has to happen. I just don't think it's really healthy for people to try to time when that's going to happen. Once the stars align, that's when you're going to be able to see it. And then usually you're going to see just huge buy volume, right? You're going to have like days where 95% of the volume is on buy side, where they're hitting the asking prices. That type of catalyst, right, is usually when we start seeing that sustainability in these type of pricing events, especially in lumber, especially in coffee, sugar, even beans for that matter. I mean, it kind of has to have that right event.
No, that's perfect. And like looking at it just from that angle, and also the one thing that I have to also say, just looking at this chart, and we're looking at it and knowing that if we're looking at this and going, okay, well, CRB is very energy based right now. If we looked at it and said, okay, let's put all the commodities equal weight, you might see this spike up to those type of levels again. But, you know, oil getting up to $200, $300 would be what it would need to be to really get to these crazy levels.
Yeah.
Because that's, you know, if you compare it to the market valuations back in those days where you see these wild spikes, it's very different from today. Like we have moved incredibly far in comparison. So it's going to be very interesting to kind of pay attention to this as the years go on.
For sure.
All right, man. Well, thank you so much for coming on, dude. That was perfect, and I hope you come on again soon, man. That was a lot of fun.
Yeah, for sure, man. And then like by all means, like just hit me up and like let me know. I'm usually open to doing these things, and then I think next time too, like I can, you know, bounce some stuff, you know, we go back and forth too, right? I can bring
Cool.
some other different charts that you're kind of looking at. Especially if we do see kind of like crude moving back to that upside like it's doing right now. I think it would be a nice like case study, right? To
Yeah.
see, all right, how did this thing talk? Because we've been talking about it for a whole month now, right?
Mm-hmm.
How did this
Yeah.
whole thing, you know, pan out here? We can kind of, you know, show people in real time some of the areas. So I really do appreciate you having me on
Of
today,
course,
Jason.
Kevin. Anytime, man. You're more than welcome. This was a lot of fun, and please, like, if you have any ideas, just hit me up or whatever. And everybody, I'm sure everybody's gonna love this one. So thanks so much for
Thank you.
coming on, man.
Thanks, man. I'll see you later. You gonna be on Spaces later?
I will be on Spaces later. Yep.
All
So
right. I'll
I
see
will
you then.
definitely be on. All right, man.